Hey there, thanks for tuning in. Welcome to Investing in Germany. And today let's have a look at the inflation in the stock market. So the inflation in Germany, it's quite high. It's not surprise anymore. September 2022 recorded 10.9 percentage. Most of the inflation in Germany has been imported through the electricity gas prices, which resulted in the increase in the transportation costs, and then which also adds to the cost of the food and beverages. It's all piling up on top of each other, and we have a really high inflation rate. If you look at the last 20 years data of the inflation rate in Germany, we were never been in such an high inflation rate. We were hovering around, let's say, 1.5 to 2.5 with some ups and downs and spikes due to the macroeconomic situation around the world, like the financial crisis and the debt crisis in the euro area. But then we recovered quite fast. It was not a really major issue within the euro area. But now, since a year or so, we have really high inflation rate. It's just spiking almost every month, and it doesn't look like it is going to cool down anytime soon. There are two main factors which really caused this spike in the inflation. First is the COVID-related lockdowns, which resulted in quantitative easing, increasing the liquidity in the market. So there was too much money in the market, which really increased the inflation. And then we had the supply chain stress due to the pent-up demand once the country started opening up. So this also created inflation. And to add to this, now we have a zero COVID policy in China, which is really adding a massive amount of inflation stress on top of the existing stress, which is really causing this inflation. In the second factor is the Russia-Ukraine war, which has really spiked the gas price in Germany. It has cooled down recently from its highs in August, but then once the winter starts, then the price is going to go up and the inflation is going to again go up. The two factors, the COVID-related supply chain issues and the gas price increase due to the Russia-Ukraine war, is not going to end anytime soon. So we are going to see this high inflation rate for some time. So we have to live with it, and then we can see how we can try to manage it over the period of time. So the inflation is not just the euro area or the Germany issue, it's a worldwide issue. As you can see here, almost all the countries are painted in red. So almost all the major economies around the world have their inflation above their target rates. One of the most interesting factor here to see is that the developed economy is having a high inflation rate compared to the emerging market. So this is quite interesting to see. And also the China has a really low inflation rate. We have to take this with a pinch of salt, because in China we have a zero COVID policy, which means that the demand is being artificially suppressed. So once the economy starts to open up and the demand increases, then the inflation could go up. We don't know yet how it's going to pan out, but then there is also a risk that China will enter into the high inflation environment. Did the inflation peak? No, not yet. The economists are predicting that the inflation will peak at the end of 2022. But it's quite questionable, because we still have the energy crisis, which is in the very nascent state, and then we also have the zero COVID policy in China, which is also ongoing. So we have to wait and watch how the inflation is going to pan out. But I suspect that we will see the peak inflation rate until the Q2 2023. The monetary policy for the Germany is being set by the European Central Bank. So European Central Bank's target rate of inflation in euro area is 2%. You might have already guessed, we are almost more than 5 times the target. So it's going to take a while before we reach the 2% target. There are two ways to reach the 2% target. One could be a hard landing, where the policymakers could really tighten the grip, increase the interest rate, and then reduce the available liquidity in the market, which means that the economy will go deep into recession. Or the other way is to go for a soft landing, where the policymakers, they will start increasing the interest rate very gradually, and then wait and watch how the market reacts, and then try to navigate through the uncertainties. In this case, then we will have a really high inflation rate for some period of time. So we have to wait and watch how the policymakers and the politicians within the European area are planning to do this. One of the effective way of controlling the inflation is by increasing the interest rates. As you can see here, almost all the economies around the world are increasing the interest rates. There are some countries which are going the other direction, but they will follow the herd in a matter of time. So the US interest rate is expected to peak at around 4.0 to 4.5%. But nobody knows exactly where the peak is and how the peak is going to be reached. Is it going to be really high steps or slow steps? Nobody knows. I don't think even the Fed knows. They are just having an eye on the market and then making call on this. The real question is whether the ECB will reach that high level of interest rate like 4.0, 4.5. The answer is they will keep increasing the interest rate, but I don't think they will reach their high interest rate like 4.0 or 4.5 like the Americans. The reason here is because the ECB is in a really complex situation, and the ECB itself is a really complex system. Let me explain the ECB complexity with this curve here, which relates the inflation rate and the unemployment. The theory is that if the unemployment is very high, there are more people without jobs, so they tend to reduce the demand in the market, therefore the inflation comes down. If you look at the unemployment rates within the euro area, we have this Spain, which is currently at around 12.5%, and we have Germany at around 3%, something like that. So it's really hard for the ECB to define the interest rate without affecting the Spanish economy. High interest rates could even bring then unemployment beyond 30%. That is really, really crazy. So I don't think ECB is in the situation where they can really reach the target of the Americans' interest rates. The economists of the market is predicting that the European Central Bank would peak at around 2.753%. One of the most difficult part here by increasing the interest rate to combat the inflation is that it takes at least 12 to 18 months for the interest rate to really bring a meaningful impact in the inflation in the market. It's a long gap, long wait, 12 to 18 months to see any fruits in the market. So it's a really hard situation for the ECB. If you look at the European economic indicators, we are really at a very bad state. This is really fairly new, 30th of September 2022, reported by the JP Morgan Asset Management. You can see that almost all the indicators are in the red. So we are at the verge of entering into the recession within the euro area as well as in Germany. So this is not anymore a surprise. We can see it all over the place. Why do somebody want to invest the money in the stock market when the market is going down, the demand is going down, and there is a lot of stress and a lot of uncertainty in the markets? If there is a risk-free government bonds which is giving you 4.5% interest rate, and there is no risk in this interest rate, so why would somebody just go to stock market? So the money flows from the stock market directly into the government bonds. So that is why you see that the stock market really tanks when the recession starts in, and also the interest rates goes up. On the one hand, we have the ECB trying to reduce the liquidity in the market by increasing interest rate. On the other side, we have the Germany fiscal policy makers giving the free money in the economy and increasing the liquidity in the market. So this is not going to work. If this continues, the free money, the free package, then we will have high liquidity in the market, which means that we will have a high inflation rate for extended period of time, which means that we will enter into the recession because the ECB is going to keep increasing the interest rates. So all this free money, freebies that we are getting is just not gonna work. The government has to take a strong stand here, try to bring down the inflation rate really fast, and then start again fresh. So in stock market is going to be a hell of a roller coaster ride. There will be a lot of ups, a lot of downs. We have really good companies reporting really bad results. Even recently we had Microsoft and we have the Alphabet really reporting really very bad numbers. Even though we still say that we have not entered into recession, we can see that already the companies, the big giants, are really facing issue in maintaining their growth rate. The businesses are going to have a really hard time in increasing their revenue or maintaining their revenue targets. So sit tight, enjoy the ride, don't leave the market. This is a time when you can really make huge wealth when the market is going down. So it could be really hard for somebody to see that stocks they have chosen goes down 20 to 30%. But then it's a short term. Look for the quality companies, quality businesses, which is going to be there for the next 10-20 years. The market will recover and these big quality businesses will do well. So this is the right time to be in the market. I'm in the market. I'm fully invested. I'm really happy to see the markets going down because it gives a lot of opportunity to enter into the market. Remember that price is what you pay, value is what you get. If you're new to stock market or you don't understand the valuation of the company, how to evaluate the company, it's better to stay within the ETF. If you're really into the valuation and so on, so this is the right moment to be in the market. Find those mispriced bets and then stick to it, and then you will make a lot of wealth in this downturn of the economy. So sit tight, enjoy the ride. See you in the next video.